in the syndication business. And like Veena, we are focused mainly on Texas and Florida. We love those markets. And I think the one thing that I would say about the way we operate is that we're super conservative. So similar to what Veena mentioned, we have, we're very, very particular about the deals that we're looking at right now. We have about 2,000 units right now, and some of the investments we make as passive investors, and some of them we're actually taking a more active role as syndicators. And I'm very excited to be here today and talk about raising capital. The interesting thing about raising capital at Blue Lake is that most of, I would say around 70 to 75% of the capital that we raise is basically from people that are outside of our network. So people that I haven't met before. Of course, they're all accredited, but we're using social media and other forms of communications to bring in capital. And I think that has been really, really, it has been working great for us because there's a limit. There's so much you can do with your current network. And as I mentioned, I'm super excited to be here today.
Excellent. Thanks for sharing a little bit about yourself. Let's go now to Brian and let you tell us a little bit about yourself.
All right. Hello, everybody. I'm Brian Burke. I'm the president and CEO of Praxis Capital. We're a multifamily syndication shop, and just like everybody else, it seems like on this panel, I started out in the single family space, and after doing about 500 single family flips, and then at the bottom of the market, bought over 100 single family rental homes in the San Francisco Bay Area. I knew that the single family space opportunity, even after 30 years of doing it, was a limited lifespan, at least here in California. Our focus turned even more to multifamily. It's a business I got into in 2002. So we've got about 17 or 18 years experience in multifamily. Right now, we've got a portfolio of just over 2,000 units. They're all owned in-house with syndicated equity. During the last 30 years, I've raised almost $100 million, kind of the hard way, from individual high net worth investors and family offices. We've never had a syndicator, join in our group to bring us equity, and we don't bring equity to other people's deals. It's all just been in-house stuff. And our firm has grown now to the point where I've got quite a strong team with a chief investment officer and a CFO. And we started our own property management company a while back. And I've got a CEO that runs my property management company. And between the four of us, we've got 105,000 units of multifamily experience, ranging from 20-year career for the newest guy to 40 years for the longest term guy. And we're currently buying in Arizona, Georgia, Texas, Florida, also looking in the Carolinas and a few other markets like Denver and Salt Lake City.
Excellent. Well, we have quite an experienced panel then today when we're talking about raising private capital and what that means for your deals. So I have a list of questions here, and we're just going to start and go in this order. So I'm going to start with you, Ryan. We're going to go in the same order that I had you introduce yourselves, and the question is going to be the same for each of you. So we've already gone over your background and kind of what you're doing and what kind of money you've raised to date. But Ryan, what do you think is the most important foundational thing required to begin raising capital?
So I would say for me, a lot of it just starts with a belief in yourself and the right mindset that you truly believe what you're doing is going to help others, that you're going to be providing value. And I think, I wouldn't want to be sharing something I was doing with others if I didn't truly believe that this was going to be, a great fit for them or something that they could benefit from. So I would say philosophically, it starts with your mind and a great belief system, confidence. But then more tactically, I would say, we all have really strong relationships. We know how important those are, but it's more about the process. And this isn't something when you're first going out and making the introduction to, a deal. You want to start way in advance with compiling a list of people that might have interest. And that's essentially, what I did. And I kind of, over the years, they knew that I was out investing, and again, didn't have opportunities to really bring them in, but I wanted them to know that, look, I sat down, had, calls, coffees, and, really kind of, anticipated having some opportunities. And so when I did, I really had kind of a list built out of who was interested, and we kind of just hit the ground running. So I would say, foundationally, it's, you're leveraging your relationships, the trust that you've built over the years, but you also want to have a solid process in place. And I think it starts with kind of identifying who in your network would have interest, and then just getting ahead of things. So when that opportunity does come, they're aware of what you're doing, and they can make a quicker decision when you bring them an opportunity.
Okay. All right. Excellent. And Veena, also for you and your opinion, what do you think is the most important foundational thing required to begin raising capital?
Yeah, so I think Ryan had a lot of good points, and I totally agree with those. So what I'll add to that is having really great deal flow. I think when you have a good deal off the bat, the money kind of follows it. So I would tell someone who's starting by raising capital, if you're partnering with somebody who has a great resume and track record, that'll make it a lot easier to kind of present the team as a whole to your investors. And the other thing with that too is making sure you understand the deal structure, and you're not just, we underwrite every deal we raise for, whether it's in-house or for another syndicator. We underwrite every deal with our own assumptions, our own analysis. I think Ellie does the same thing. And we do that because we like to really understand what we're putting in front of our investors, because we spend a lot of time and energy and effort cultivating those relationships, like Ryan said. And we're always technically raising money, right? So no matter whether or not we have a deal in front of us or not, we're always adding value to our investors. We're educating, especially getting out in front of some of the changes that we're starting to see in the market. We're prepping our investors so that it's not a surprise for them when we put a new deal in front of them. And to foster those relationships, actually, my partners and I, we speak to every single one of our investors regularly. We reach out via phone call, text, email, but we're always in communication with our investors, and we know them on a very deeply personal level as well. So I think that having good deal flow and knowing why it's a good deal is really important, and understanding the numbers and the business plan and the function behind it is kind of the first step to going out and raising capital, because then you can speak more effectively and you can give a lot more background to the investors on what exactly you're doing and why you like it. And so I think that those things kind of go hand in hand.
Okay. Thank you, Veena. And let's move to you, Ellie. What is, in your opinion, is the most foundational or the most important thing when beginning to raise capital?
So I think when someone just, if someone is just starting raising capital and getting into the syndication business, I'm a huge believer in knowledge. So I have 3 degrees, 2 of them in law and business law. And so I really value education. And I think when you just start and when you have, enough knowledge, that will open so many doors for you, because investors, doesn't matter if they know you or it's, if it's your friends and family or someone you just met at a conference and you're trying to build a relationship with that person, coming from having a solid knowledge base gives you confidence and positions you as an expert, and it ultimately helps when because raising capital, because investors, they're always vetting. They're not only vetting the deals and looking at the numbers and the market, they also, before they do that, they look at you and they try to vet you and they try to see if they like you, if they trust you. And part of trusting someone is making sure that this person is professional, that they know what they're talking about. So even if you just start, don't feel, I see, a lot of people that just start in syndications and they're gaining knowledge and they still feel a bit insecure about not being, experts in that field. But just remember that you always know more than other people who are just starting or who never, invest in real estate or never took the time, the energy, or invested anything in learning that space. So the more you learn, the more experience and knowledge you're going to have, the more confidence you're going to have. And that's definitely going to help with raising capital. So I think, education, I'm a huge believer in education. So I think that's one of the most important thing when someone is just beginning raising capital.
Okay, thank you so much. And Brian, we're going to hand it over to you. Get your take on what's the most important thing when you start out raising capital.
Well, I think the most important foundational component is to have some level of a demonstrable track record. And what I mean by that is, you want to be able to show the investor what you've done and how you've performed, and especially how you've performed under pressure. If you turn the tables and you think, okay, I'm going to raise money, I'm going to ask somebody to give me $100,000. And you think to yourself, that should be really easy. Of course, I've got a great deal. They're going to want to invest in it. But think about it if that was your $100,000. And what would you have to know about the person you're going to hand that money over to before you hand that money over? And what you're going to want to know is you're going to want to know that that person knows what they're doing and that they're going to be able to perform on the plan that they set forth. And the only way you can really gain any level of comfort with that is to have seen what they've done in the past. So if you're a new syndicator looking to raise money for the first time and you don't have a track record, you need to get one. And what I mean by that is a lot of people say, just go straight into large multifamily deals, bypass everything else in the real estate space and just go for the big time. And I just don't believe that works. The very first property I bought was like a $80,000 mobile home. And now I've grown it into buying over $400 million in real estate. And it didn't happen because I went straight to the big time. I had to demonstrate a track record, put together small deals by kicking and scratching and borrowing and, cash advancing credit cards and credit lines and everything I could do to buy deals and show investors that I was worthy of their investment. And then documenting that so that I could then have something to show people down the line. Because if they don't trust you, they're not going to invest with you. Component part of a track record is being able to underwrite properly and to recognize a good deal when you see one. And why track record is so important is because the only way you learn how to underwrite properly and recognize a good deal when you see one is by having been around the block a few times. And I remember as a young real estate investor out doing my first, 20 or 30 deals, everything I saw was a great deal. It's like being a kid in a candy store. Like, this is the greatest thing I've ever seen. This is the best deal ever. And it would have sucked. I mean, they were horrible deals looking back on it, going, what was I thinking? So, the track record and experience builds up, the character that you need to be able to be trustworthy of other people's funds.
All right, that's excellent advice from everybody on the panel, and I hope everybody's taking notes so far. And so we want to keep moving with all this great wisdom and knowledge from this experienced panel. And I'm going to flip back to you, Ryan, and ask our next question. That's going to be, how do you manage your investor relations, such as CRM systems and frequency of contact, et cetera?
So the main, CRM system I use is MailChimp. It's what I use to put together all of our announcements when we have an upcoming opportunity. It's our monthly newsletters, our quarterly updates, when someone's in a deal, we'll send out a monthly update. It'll come from our distribution list for that particular deal in MailChimp. So it's an easy way to create some templates and then to kind of organize the investors, the people that are on your distribution list. And so it's really a streamline things. It's very easy to get information in front of investors that way. I also do the old, traditional email as well. If I want a little bit more personal touch, I will send a direct email kind of in conjunction with some of the MailChimp stuff. But I would say, MailChimp is probably the best system I've seen out there as far as doing what I'm doing, and it's allowed me to leverage a lot of my time and reach a lot of people very quickly. And
how often do you like to reach out to people using that system?
So there's a fine line of too much contact and just enough. So I guess it's a great question for all my investors, but I would say, I like to, keep people in the loop. I like to let people know what's going on, but I also don't want to be sending out too much information that, it's flooding their inbox. And so I really try, when I make an announcement or send something out, I want it to be of value. I want it to be something that's important. I don't want to just send, blast an email out just to blast an email. So usually there's a purpose for it. And so I do try to be very selective in how often. So I would say on any particular deal I do, there might be, several emails that go out. But mainly it's, the deal announcement. And then a lot of our deals have filled up very quickly. So maybe it's hey, the deal's oversubscribed, we're taking backup. That might be like a second email. And then, hey, maybe a spot opened up, might be a third email, or maybe there's a new piece of information about that particular deal that I want to get out, like a webinar that's coming up. But there's, maybe 4 or 5, touches throughout any one particular deal. And then once I get commitments, there'll be more touches with those individual investors for that particular deal. And I leave everyone else off because I don't want them to just get, random emails about a deal that maybe they're not interested in. So that's kind of the cadence I work with. But in general, I'm touching all of my investors, once a month with a monthly newsletter that just kind of summarizes what we're doing and maybe some deals that are on the horizon and some deals that are closing soon. So I think that's, a good, effective, way to touch and to be purposeful about, when you reach out.
And let me just follow up with a secondary question. And I know the answer to it, but I want you to state it and kind of be thinking this, other panelists. What is there a difference in frequency of contact between potential investors and investors that are return investors?
Yeah, I would say the return investors, they kind of understand the process. They know, kind of the next steps. So definitely there's more interaction, more communication with a new investor. And that it might also involve, calls. I mean, I'm always happy to jump on a call to, help walk through something. I've tried to be, purposeful with, laying out the steps ahead of time and anticipating those questions. So they know what it's like to invest in a deal. They know the steps involved. They know the timing, because a lot of investors get excited about the first deal. And then, on our end, we're kind of waiting for more information to come out sometimes. And so there's that period where it can go quiet after initial commitment. And so I just try to let them know, like, look, you're in a good spot. There's nothing, that you need to do right now. I'll be in touch as soon as we have kind of that next piece of information. So definitely with newer investors, there is more touch points. And then once, an investor's done a deal, it's usually pretty seamless after that, unless there's questions about the particular deal. But that's been my experience.
Okay, excellent. Thanks. Veena, what's your take?
Yeah, so it's funny because I saw Ryan a month ago and I gave him this feedback that I think he does an excellent job of balancing how much he reaches out, because I am on his investor list and I think he does a phenomenal job with his outbound marketing. So Ryan, you're right on track.
Thank you,
Veena. Absolutely. As far as Enzo goes, we actually have a very similar style to Ryan. We have a massive investor list or database. So there's 3 different buckets, right? So there's our overall list. That's everybody, people that haven't invested before, people that we have relationships with that are looking to invest. It's our master list. The second bucket is investors that have invested with us before and they're coming back to invest again. Most of our investors, actually all of our investors that have invested and gotten a capital check back in a large amount have actually reinvested with us. So a lot of our investors are in 2, 3, 4, 5 deals with us. And then the third bucket is people that are investing with us on that specific project for the first time. We utilize MailChimp as well. We've actually just enrolled in Infusionsoft. So it's going to kind of take out some of that manual labor of MailChimp, because we can set up automated campaigns and buckets to kind of keep touch points going throughout the entire sales cycle, so to speak. So when an investor goes to our website and they click our form to sign up to be on the email list, it'll respond to you with an automated email, and it'll actually ask you for a time that you can schedule, because one of the partners will speak to you before you'll get any of our offerings. So then that kind of sets up that cadence. Now we are actually getting ready to roll out a new investor portal. IMS is kind of the favorite. So we just signed up on that. It takes about 3 to 6 months to get it implemented. But what it'll be is it'll be an investor portal where all of our investors they'll have their individual logins. They can log in, they can see which assets they're invested into in our portfolio. They can get their quarterly financials there. They can get their monthly updates. They can get pictures. They can get their K1s will be pushed out through there. All of their PPM documents and everything will be in there. And they can use that as a place where they change or upload bank information, address information, et cetera, et cetera. And they'll be able to see a record of how much they've been paid out to date and what the IRR looks like and where the waterfall sits. So it's actually a very robust CRM system that'll allow us to have a little bit better of an access point for our investors. In addition to that, I spend a lot of time reaching out to our investors. As soon as we send a first check back, I actually make it a point to reach out individually to all the investors in that deal. And I mean, because it's a great touch point, right? It's a wonderful phone call to make when you're calling and say, hey, I just deposited money. Did you see it? And so it just adds a little bit of extra. And then what we found in doing that is every now and then they'll have like mistyped a bank account number, so they won't have gotten it. So it's easy for me to go and trace what happened, recall it, and resend it out to them. So typically after we close a deal, I reach out. I have 2 extra touch points with our investors in that deal. First one is the first month and then that they get a check. And then the second one is the second month that they get that check. We also send a monthly newsletter out to our entire database. We don't send a whole lot more than that because we just try to keep it very minimal in terms of how much goes into the inbox. Mid-raise, you'll definitely see a lot more emails from us. You'll see a coming soon email. You'll see, hey, we're under contract. Here's the OM, make a soft commitment email. Then you'll see your, hey, we're 50% subscribed or whatever that number is. And then when we oversubscribe on our email or on our projects, we then put out a wait list similar to what Ryan's doing. All of our projects are over funding right now. So one of the things that we do, I think maybe a little bit differently, I don't know what other syndicators are doing, but we offer all of our offerings first to current and previous investors. So we kind of reward that loyalty. There's a lot of instances where we send that out and then we just never can take a new investor into it because we oversubscribe from our current database. But if there's room, then that second tranche will go out to the investor database that have actually been in contact and have an existing relationship with one of the partners.
Excellent. Thank you, Veena. And before I get to you, Ellie, I wanted to introduce David Thompson, who just joined us. David, how you doing? Oh, I think I got you muted. Hold on one second. Can you hear me?
I'm on Central, not Eastern, so sorry I missed the other wonderful panelists. If I missed their introduction, I'll have to call you. I know most of you on the panel, which is great. I haven't met Brian before, but I've heard his name many times. And Ryan, we work with closely. Veena, I see a lot. And Ellie, I've talked to you before, so it's fantastic. It's a small world, but it's a great group.
Brandon, I think you have us all muted and no one can hear anything right now.
Yeah. If you asked me a question, I missed that one.
Got you. Can you hear me now?
Yes, now we can hear you.
All right. David, what I was saying was we're going through a question right now that Ellie and Brian are going to answer and that Ryan and Veena had just answered. And that's how do you manage your investor relations such as CRM systems and frequency of contact and difference in contacting potential investors and return investors. So we're going to hand it over to Ellie and let her answer that. And then David, just so you know that question when it comes to you.
Okay, thanks.
All right, so pretty much similar to what you've heard so far, I'm actually using similar systems. I love MailChimp, and that's what I use with my investors. And similar to what Veena mentioned, we have certain buckets of contacts. So I have a lot of contacts of people who go to my website and register for updates. So we use MailChimp to deliver a weekly newsletter, which is basically an aggregate thing that I've done so far in social media, the articles that I've written that week, the podcast that I've hosted, or if I was a guest at someone else's podcast. So and we have a pretty high rate of people who open and click on the links there. So that's one kind of one frequency. That's the weekly newsletter that we send it to all of our investors, the current investor, the potential investors, and also people who just register for updates on the website. And then when it comes to specific to current investors, I'm also using MailChimp to send them a monthly report. So every month they receive a report that describes what happened with the property, what's the status on the renovation, if we're doing renovation, what's the occupancy level, if there's anything funny, weird, good, bad, ugly, everything we put there. And that's a very easy way for us to communicate with investors. I'm also looking into IMS. I think it's a really interesting platform. I'm coming from the tech world myself. I think this is it's definitely something that is going to be very beneficial for investors. And then in addition, we pretty much tailor the communication style and the frequency with investors. So, there's some family offices that don't need a monthly phone call asking, how are you guys doing? So they would prefer a different type of communications, or they're only interested in hearing once we have a deal. And then you have others, mainly high net worth individuals, that, I reach out to in different ways, text messaging or emails or phone calls, just to sometimes just to say hi, see if they have any questions, and kind of try and make it not so much transactional, but also very personal. So the next time, they think of investing, I'll be in their, I'll be in their mind as a potential for investment. So that's what we've used. I know that besides MailChimp, I know some syndicators that are using ActiveCampaign, which is another platform. I think cost-wise, they're pretty much the same, and I think each of them probably, or maybe MailChimp only has a freemium version, but that's what we use to communicate with our investors and with the general kind of the gen pop of subscribers to our website. So hopefully we'll be able to convert them from subscribers to investors.
Excellent. Thank you. And Brian, what's your preferred method and frequency of contact?
Well, I would look at communication in kind of two different buckets. There's the pre-investment bucket and the post-investment bucket. We excel at one and not so much at the other. So where we're really good is we're really good with communication with our existing investors. We use a portal system. I've heard a couple people mention IMS. We evaluated IMS as well, but we chose a portal called Juniper Square, which is similar to IMS, but a white label program that integrates with our website so our investors can see exactly what's going on with all their investments and what they've invested in, look at all their distribution history, quarterly reports. It archives all their K1s, all that sort of stuff. So, we have that available to them 24/7, and then we communicate with them by issuing quarterly reports. Each quarter, we issue the investors in each particular deal a report that talks about what's going on, gives a narrative about kind of the important points and things that are important to them, and also gives them a full rundown on the financial performance, then also includes a comparison of the actual performance relative to the performance that we projected in the initial projections we sent them when they made their investment decision. And then of course, if there's any unusual event like a fire or something like that, we communicate with our investors immediately and deliver that sort of news when and as it happens. The before investment part is probably our weakest part. I heard a lot of people say they use MailChimp, and I heard Infusionsoft and ActiveCampaign and all these kinds of things to give touch points to investors. And, quite frankly, we're just horrible at that. We really don't do anything. We don't have any email system. We don't do any outreach. All of our investors come to us by word of mouth, referrals. They read about us in the media or some news article or something like that, or hear on a podcast. It's one of my goals for 2019 is to improve that side of our communication, just because it's a recruitment issue. We're really good at talking to you when you invest with us, but we're not that great at recruitment. Most of our stuff is all just organic inbound traffic that we get, and I don't even know how we get it, but we do. I guess it's track record. Most of our communications is all handled through my senior vice president of investor relations, Bob Dreher, here in my office. He's dedicated solely to interfacing with investors, communicating with them. Every time we get a new inbound investor lead, we set up a telephone call, spend about an hour on the phone with the prospect to learn more about them, their goals and objectives, and determine whether or not we're a mutual fit. We don't want anybody in any of our investments that aren't a perfect fit. And vice versa. We wouldn't want to be in their portfolio if we're not a fit for them. So we definitely like to have a conversation with all new investors before they even get into the system at all. When we have a new offering, we send out an email, through our portal CRM with a data room button that they can click in and view basic information about the offering, and then we just basically start writing down names on our list. So we tend not to send repetitive emails. Generally speaking, our stuff will fill up within a day or so just off of that first announcement. So we just need to get better at the email thing, I think.
Excellent. Thank you for that feedback. And David, we're going to switch to you now. And everybody else kind of introduced themselves when we started off, and we missed your introduction. So I'd like to just give you a few minutes just to tell us a little bit about yourself. What's your background, where you're at now, and then we'll touch base on this question that we've been dealing with.
Yeah, no, I appreciate you handling both opportunities here for me. It's time late. So real quick, I started really in the syndication and capital raising business about almost 3 years ago. I came in through a person that I think emceed the show today, Joe Fairless. I started working with Joe, and then after about 3 months, I was kind of a mentee, learning to do my own apartments at some point. But I feel like that was going to be a tough road, so I decided to just join them, which is actually my number one tip. If we get to it, will be just partner with experts. That's how the best way to start if you're a capital raiser. I did one deal after another with him as part of the general partnership team, and then after a while, I discovered that investors wanted to do more than just apartments in Dallas, Texas. So I decided that I liked some other areas too. So I'm now doing self-storage, mobile home parks as well. Added those couple niches and then different geographies and some different operators. So I'm on the GP side of, I think we've done 21 deals. So very active, did 13 last year, was quite busy. I'm not sure if I want to do that many again this year. I want to do bigger deals. I've sponsored some deals. Thompson Investing has done that great. So I don't know, we're 21 projects. Most of those are multifamily, probably 15 to 18, maybe I think we did 3 self-storage deals and 1 mobile home park fund. I'm having a ball. I'm doing exactly what I should be doing, and I wish I would have started when I was 10. But anyway, having a great time doing it. As far as what the folks have talked about here, I mean, just a great elite group here. I'm really excited to be part of it. And I'm always learning from the peers. I mean, that's the best way to get really better at your craft. I'm not going to talk about a lot of the things they said because I do all of those things. I like the way Brian framed it, pre and post. And it could be another framing mechanism, could be new investor versus a return investor, because we don't want to treat them differently, but there's obviously a different expectation. And I think maybe it was Ellie or Veena mentioned we do give priority to return investors to encourage them to keep coming back for more deals. The biggest way I got started, and Joe taught me this early on, was thought leadership. And so I didn't know what I'd like to do, but I started writing. So blogging was a big area for me. And basically I post blogs on Bigger Pockets and I put them on my website. I wouldn't actually send it out to my newsletter group. I said, you're already getting my monthly newsletter. I don't want to send you another email out. So I just basically put my blog links in my monthly newsletter. They get to see them at some point, and maybe it's not so time sensitive. Like this last week, I talked about my family vacation to Asia. So I want to tell people that it's, we're real people here. We're investing in our own deals, and we're all about making sure there's a family behind this. There's personal people that care about you and care about our money putting together in the same deal with you. So, but I use MailChimp. We do a monthly newsletter. We do. I think most of my traffic comes to my website. Brian was mentioning people come to us now. I mean, I think return investors and referrals are probably 90% of my business, which is fantastic. So when you start out capital raising, the hardest part is getting started. But partner with experts until you can fly on your own, and then once you get going, it really is it's a great game. I mean, we really enjoy it. But most of it's coming through the website. We do exactly what Brian does. We vet the people. We try to get them on a call for 30 minutes and really understand what they're trying to do and how we might fit into their plans. We have to be careful of the rules, so we have to make sure we vet them as they're accredited and make sure that we have a conversation with them, establish some type of relationship. But then they go in a database. They're getting the monthly updates. When we have a new deal, they get an alert, right? We're not waiting for the monthly update. We need to get people interested in these deals. And then the MailChimp is great because you can establish lists for projects. You get 21 projects. You need to send out monthly updates. I think that's the best. We do have operators that do quarterly, and that's fine. But I think monthly, people really appreciate that small touch point, and then quarterly, the financials. Yeah, and that's about it. I don't really think there's anything unique that we're doing. I think that keeping it simple is really important, and finding what works, and then learning from your peers and the people that are really doing it. At the end of the day, I know Brian mentioned track record, and that's super important, but I would think equally as important is customer experience and the relationship that you're developing. I've had investors look at 2 deals from me, one where we're a sponsor and one where they can go direct to the operator and get a better deal financially, same track record, but they went with me because they know who I am. And they know they can trust me and keep coming back for good information, good communications if they have any questions. I think
Excellent.
That's it, Brandon.
Well, that was great feedback from everybody on the panel. Thank you for that. The personal aspect, I like that, David, how you share about your vacation and have it not be so sterile and businesslike. So I think that's a wise thing to do. So let's go on to our next question. I'm going to skip the next one. I like this one a little bit better. Ryan, we're going to start with you again. In your opinion, do you need to own money or have your own money to invest in deals before you begin to raise capital? In other words, does your net worth need to be to the point where you're seeking peer investors? Oh, I got you muted there.
I'm muted.
Yeah, there you go.
Good now. Okay. So I would say for me personally, I do believe it's important to, put your money into these deals as well. It shows investor alignment. Again, it goes back to that belief. If I believe in the deal and I want to share it with other people in my network, I just think it's important to show them that you've got skin in the game and that you're along for the ride as well. And I look at this as a team sport, and I always tell my investors that, hey, we're all in this together. We're all growing together, and it's kind of fun when you can do that and participate in the deal. So I really do think it's important to put your money into these opportunities because it shows a level of seriousness. It shows that you've done your due diligence and that you're just as excited about the opportunity and to get your capital to work as well.
How do you feel that plays into, like, when you're trying to meet investors? How do you go about what areas are you looking for investors in? Like, when I say like your own money, or like, let's say, for example, like, I don't have any money in my checking account, but I want you to invest in my deal because I'm so good with money, that sort of thing. So how does that kind of play into, like, what circles you run in and those sort of things?
So, I mean, I guess the circles I run in, I think, is important, especially kind of identifying, the type of investors that you want to work with, because at the end of the day, this is a relationship business. So, I tend to kind of gravitate towards people that I think are like-minded, that, want to do similar things. And I just kind of always viewed myself as an entrepreneur. So I naturally gravitate to, business owners. And for me, it's about, creating additional streams of income. And if you're a busy working professional or you have a business and you can only dedicate so much time to, real estate investing, these vehicles are great for that. And one area I'll mention that I've had some success just connecting with investors is the angel investing world. I'm part of Irish Angels. It's a affiliate of Notre Dame. And I've connected with a ton of angel investors who don't necessarily know about the structure of our deals. And I find it very compelling to kind of just share, because I do some angel investing as well. And that's a structure where you've got your capital tied up for many years, 7-8 years, and there's no cash flow. And there's a high likelihood that the deal might fail early on. And so to kind of introduce them to the type of investing that we do with the syndication business, whether that's multifamily, self-storage, mobile home parks. I mean, from a diversification standpoint, they get it right away because they're investors, and they're looking to, kind of, I guess, mitigate some of the risk. And so I've seen a lot from those circles who also, want to participate. And again, they're investors kind of by trade with what they're doing. And so most people I'm reaching out to, I mean, have some sort of capital, have invested before. I would say they're pretty sophisticated. But at the end of the day, if they like the people that they're working with, I know Dave mentioned that as well, they're having a good experience. I mean, let's face it, there's a lot of deals out there, and they could probably go anywhere to kind of get access to the deal. But I think if you provide a great experience and they want to work with you, and you're very responsive and trustworthy, I think you're going to over time develop some great relationships, and people are going to keep coming back to you, and they're going to start telling others about what you're doing. And that's how, the business, I think, really grows. And I'm starting to see a lot of that now, where, people are coming to the website, people are sharing, our deal flow with others. And, I think that's great, just a great sign that, you're kind of on the right path. And so that's all I really have to add to that.
Gotcha. All right, Veena, I've got you unmuted now. So what is in your opinion, is the benefit of having or being invested in a deal that you're wanting to put together or raising capital for? And at what level do you like to be invested, if that is the case, in accordance with your investors?
Yeah, so we always have the GP side invested into all of our deals. I think it just adds a lot of credibility to the investment. When I'm going to an investor and asking you, hey, trust me with your money, I really believe in this project. Oh, but I'm not putting my own money in. I'm only going to put your money in. It kind of changes the conversation. Ironically, what has happened with the Enzo model is, so the last deal we did in Jacksonville, between my partner and I, we had about $350,000 in the deal ourselves on the LP side. And we overfunded that by so much that we had to give certain of our preferred investors who invest in everything, we had to create a slice for them. So we both we were negotiating who gets kicked out more than the other partner. So we started out at 350. We ended up with like 200,000 in that deal. And so we like to invest into our deals because we believe in them and we believe that they are going to perform. And if I'm asking an investor to trust me with their money, I feel like we should also be willing to put our money up beside that. And, also we're obviously KPing on the loan, and we have a lot of other involvement, but I think the money aspect really does make a difference. When I invest passively into other deals, that's actually the first question I ask is the GP side investing, and how much are they putting into the deal? Our deals can sometimes be as high as 10% of the fund is from some permutation of our 4 partners. It can be, I think, like at 2% or 1%, it's still something that's significant to them to have skin in the game. So that's kind of what we look for and what we do. Now, within our investor circle, the vast majority of our investors are physicians and dentists and orthodontists and like kind of those medical professionals. That's purely just by the circles we run in. All 4 of my partners are connected to medicine in some meaningful way. My partner Pooja and I are both married to physicians. My partner Neil is a physician. My partner Span, his dad is a doctor. So it's just who we have in our normal everyday network. I assume if we were all like lawyers or engineers, our database would skew toward that profession. And what we found within the physician world specifically is us having those backgrounds and doing this as kind of a way to break free from medicine and being independent of medicine. We're seeing a lot of our colleagues coming to us saying, hey, wait, I want to do that too. I don't want to work for 15 more years, 20 more years in private practice or hospital settings. And so they see this as a way to gain financial independence outside of medicine. And I think it just, again, adds more credibility when we're saying like, look, we understand the nuances to being a medical family and we still do this X, Y, and Z, and you're welcome to join us or follow us. And I think that just gets a lot of traction from our investors.
Excellent. Thank you. I was grabbing a water real quick while you're answering.
I should have given you more time.
Yeah, excellent. Ellie, let's get your take on the importance of having money invested in the deal.
Yeah, absolutely. So Relay Capital invests in all of our deals, and it actually worked pretty well because I think when you're just starting, if you're raising money from family and friends, they can be more forgiving because they know you and they trust you and they understand you're just starting. So even if you don't have money, you don't have a skin in the game, then it could be acceptable for some of them because they understand it. But when it comes to people that you don't know, that you're just starting building relationships with, or you only know them on a professional level, then investing your own money is really crucial. And it helped me a lot when I was speaking with people that wrote, $200,000 to $500,000 checks that I've never met before. And our relationship was only based on, in a professional level. And I've never met them, but I've spoken with them on the phone. Then once they heard that I'm putting my money in the deal, and many times I tell them exactly how much I invest. And if I bring my family, my brothers-in-law, my parents-in-law in the deal, that makes them feel really good about the deal. And it shows that the deal is really solid, because if I'm confident enough in the deal that I put my own money in it and my family's money in it, it's kind of a different, game. And I'm sure at least some of the participants, the listeners, are actually, they're just starting off, and you say, okay, that's great, Ellie, you might have some money and you can invest it. Not everyone is in the same position. There's actually a creative way of doing that. So even if it's your first syndication, if you're getting, it doesn't matter if you do it on your own or partnering with someone, which I highly recommend that you do, you are getting a piece of the acquisitions fee, which is usually around 2% of the purchase price or the deal value. So if you don't have $50, $100, $200,000 to invest, you can take part of the acquisitions fee and invest that in the deal. So even if you don't have money right now, you're supposed to make some money when you close the deal. You can take those future proceeds and invest them in the deal. And in that way, if you're invested, that's going to help you raise capital and make the entire process a lot easier.
Excellent. And Brian, your take and your method on that.
Yeah, I'm going to take a counter view to most of the other panelists. I think that the idea of having money invested in a deal is a common concept that people think that that's skin in the game, that for some reason makes you either perform better or demonstrate your belief in the deal. To me, after doing $400 million in real estate over 30 years, in my view, that's complete hogwash. It has having money in a deal has absolutely nothing to do with how well we're going to select deals or how we're going to perform during those deals. When you're first getting going, I can see where having some money in a deal is going to give the illusion that you're that much more committed to it, and perhaps for some, it may even be true. My view is that after you've been in this for a while and you've demonstrated a track record and that sort of stuff, you've got a lot of skin in the game, whether there's $1 in that deal or not, because we've got $100 million of investor capital. If we screw that up even one time, that's the end of a $400 million business. It literally is. With the internet and people can talk, and you can't afford to take those kind of chances of getting into dumb deals because it's somebody else's money. So, you've got that, your reputation, that skin in the game. I'm the 100% shareholder of this corporation. We've got 100 million in investor capital. So if somebody said to me, you have to have 10% of your own money in every deal, that would be $10 million plus. Our lenders require a net worth equal to the loan amount plus about 10% of the loan amount to be held liquid cash. So, I am the one providing that net worth and that liquidity. So in addition to having money in the deal, which now is no longer liquid, by the way, you're talking, $30-40 million to scale to the level that we have. Having my name signed on the loan, that's skin in the game. Having a reputation, that's skin in the game. Investing money in the deal is great. We love to eat what we kill, but I just think it's highly overrated. But you still need money. Even to get a deal into contract, you're going to have earnest money deposits. So you're going to have money for that. We fund all of that internally, due diligence costs. If somebody came to me and said, look, I don't have a dime to my name and I'm going to go be a big time apartment syndicator and raise money from other people and have them pay for my ticket to get there, you're shooting a little too high. Get some money of your own to be able to seed this. So what I always like to say is that my capital is the spark. My investors' capital is the fuel.
Very good take on that. And we like varying perspectives. That's what gives it, texture. And so, David, what's your take on this?
Yeah, well, it's tough to follow that act, but I really think, Brian hits it on the nose on one thing, it's your integrity, and I would absolutely agree with that. I mean, one wrong move, one stupid thing you're doing, it's all over the place. And, we did 13 deals on $200 or $300 million last year. You just know every day you get up, you need to do the right thing, right? But I will say, the other panelists talking about putting skin in the game, you understand you're talking to a lot of investors. I don't know how many investors we talk in a given year. Geez, a lot. So you're coming at investors who I don't have time to tell them about what Brian's position is, which was fantastic. And for a person who's been in the business, I 100% understand where he's coming from and we agree. But the average investor I have is the first time they've come to the syndication and they want to know if I'm putting money in this. That's a question. I'm just like, I'm not going to go off on some philosophical bent on how I think they're incorrect. However, we did 13 deals. Okay, so that's a lot of money. And even if I put 25,000 in every deal, it's a lot of money, right? So where I do get bent up on people, that sometimes they ask me how much, and I'm like, hey, it doesn't mean I don't like this deal any better, different than the last deal I just showed you. I like all these deals. I'm investing in all these deals, but keep in mind, I usually tell people a range. It could be 25, maybe it's 75, maybe it's 100. If it's something right in my backyard I really love. But at the end of the day, it's not how much money I'm putting in. I think disagree with Brian. Does not mean I have any different focus on this project. I don't believe in the project. It has nothing to do with that at all. And in fact, if you're a new person starting out, the first 3 deals I raised capital on for a variety of reasons, even though I had some capital, I didn't put money in it. And one of them we've already sold 52% gain in like 2 years. So it's not a bad investment just because David Thompson's not investing in it. It might be several personal reasons why this particular day I'm not investing in this particular deal. It has nothing to do whether I believe in that product or not. But at the end of the day, if I'm showing you the deal, I believe in it because I look at my investors as how I started with my friends and family. I don't want my friends and family in a bad deal. So now I have, 300 or 400 investors. They're still just an extension of my family. I have to go to bed at night and wake up in the morning knowing that I treated them right, showed them good deals, and serviced them well. And at the end of the day, if I did that, I feel like I've done a good job. And I don't have to worry about how much I put into the deal or the frequency or how much on every deal. It's just philosophically, I step back. Yes, you should be putting some money in the deal if you feel you should be putting money in the deal. And it will answer that question right away. You will always be able to say that. But don't worry about raising capital if you don't have capital. On that particular deal, I raised $1 million in 2 weeks in my first deal with not putting money in the game. So you can do it.
Excellent. Well, that was a great round there. I think that was one of the some very valuable information and varying opinions. And we even have some comments on the chat box to that. one person says they're a significant investor in multiple asset classes, and let's see. I want corporate CEOs heavily in their stock, startup founders with significant cash in before I invest, et cetera. Why is real estate different? People that mess up, close up, and start up under new names all the time and hide their history. Anybody want to take an open response to that? Go ahead, Brian.
I will, because I started it. I don't disagree with that. And, there's a lot of people that will do that. And you'll see guys, they'll start up a shop and, then they, they're here today, gone tomorrow, and then up another day under a new name. It's absolutely true. And it kind of goes to my point of early on when I said that, for a new syndicator, you might have to put money in that deal or otherwise no one's going to invest. It really is, once you've built up a track record and you've got really something at stake, that you can't just fold up shop and come up with a new name and start over again. I could not do that. Somebody that nobody's ever heard of could get away with that. But I absolutely could not do that. I'm too well known out there and my name gets around, and I protect my investors. I would take a bullet for them. That's where my money goes. I've put money into deals after the deal has funded. When something's not going the right way and you're like, we got a problem here, that's where my money comes in. It's to protect the investor, not to just demonstrate, some olive branch. But I don't disagree with Jeff's comment about having money in the deal because people can go away and come back. There is truth to that. And that's why I think, investing with somebody that has a long track record, has that skin in the game in a lot of different ways is the key to defense for people doing that.
Okay. And one of the questions in my Q&A box is, how would the panel suggest someone overcomes the lack of money to invest in a deal, and how to discuss that while raising money for a deal? Anybody want to take that one on?
I could take that one.
All right, go ahead, Veena.
Okay, so I think that when you're starting off raising capital, you don't necessarily have the track record. Maybe don't have the capital to put in deals. And I agree completely with what Brian said. I can't close up shop and start something in a new brand because it will be obvious what is going on here. So I agree that reputation is the most important thing that we try to protect, and we'll come in behind investors as well if necessary and kind of lift the deal up if it needs it. So we add extra capital there. I agree with Brian. When you don't have the capital to put into a deal, I suggest, and you're probably going to be doing this anyway, but you're going to be partnering with someone who is bringing a track record for you, who is KPing on the deal, who's bringing the net worth liquidity, net worth and post-close liquidity. So what really happens at that point, we have new syndicators that have worked with us before, and we bring the strength of the resume on their behalf. So they position it as, hey, we're partnering with Enzo, so that investors can see, okay, we're not just going into this blind, and the GP side is invested into the deal. It may not be this particular person, but overall the GP side is heavily invested into the deal. So that's how we get around it. But to Brian's point, it's a lot of capital. If we weren't, all four of our partners are generating capital outside of multifamily. And if we weren't, it would be much harder for us to invest as much as we do into our own deals. But we do it as our personal investing strategies as well, not just from the business side.
Okay, excellent. And Ellie, I'm going to direct a question at you. You've had a little break there, so I'm going to give you this one. This one says, what is your favorite part of raising capital / being in this space?
I'm a people's person, so I actually really enjoy meeting people. I think there's nothing better than for me getting the text message or the email saying, all right, we're in. And I actually found that it wasn't as hard as I thought it would be. It's easier for me to raise capital from people that are outside of my network. I feel, sometimes when you start talking with friends and family, when you just begin, it can be a little awkward. But for me, the best part was to get to know people. And some of those investors became closer to me because we found things that we have in common. So, it's, for me, it's all about people. And I think investors kind of feel that it's not only about, it is about the deal, but it's not only about the deal. So that's one of my favorite parts is, getting to know new people. And I think also when you have a certain goal and you surpass that goal, if you need to raise a certain amount of money and you're oversubscribed, there's no better feeling than that.
Okay, excellent. Let's see. Ryan.
Yeah.
What do your investors look for as the most important thing in a deal? Is it IRR? Is it cash on cash? What are your specific investor group looking for in a deal? What's the most important metric?
Well, I mean, numbers are great. I think, it's also the relationship with that operating partner, who they are as a person, their track record, because, anyone can put good numbers out there, but you also got to know that it's a solid relationship, that, I personally know who I'm working with and who they're investing in. So I think it starts there. And I always tell investors, all of our deals, they're all within probably 1% or 2%, just return wise, and just pick a different market. And so at the end of the day, I mean, they're like Brian said, the relationship is very important. The reputation is very important. But yeah, all the deals are, 7-8% preferred, 16 to 20% IRR, and different market, different syndicators. So I think again, that's kind of the range. And I always just share with investors, diversify. Don't ever try to put all your money into one particular deal. I just spread it out. And with our model, we do have a lot of good deal flow because we've got a lot of great partnerships. And I think it's a great way for investors to, again, spread out their risk amongst many deals, and with operating partners who we vetted, who we trust, who we believe in, who we formed long-term partnerships with. So I would say it's kind of a combination of all those things. And at the end of the day, I mean, the numbers are what they are, but I would say there's no one particular deal where we're like, oh, this is an absolute home run. You got to put everything you can into it. I mean, they're all pretty consistent. We're trying to hit doubles and triples, and the investors have been pretty happy with that deal flow.
All right. And David, I'm going to direct that question at you as well. What do your investors feel is most important?
Yeah, I mean, lots of different things there, but I think I step back, and the business I have right now is looking to help them understand what their next move could be, right? So, if we've done a lot of apartment deals, let's look at some different niches, different geographies. Ryan made a good point. We're not transactional. We do get a lot of people giving us deals because we can raise a lot of capital, which I guess is a good thing, but it's also kind of like, man, it takes a lot of time to vet you, your deal, and your market. I don't have time to do that. So, it's really important for our investors to know that, we select the partners carefully, and we tend to do deal after deal with them as long as they're in a market that we like, and the numbers are still conservative, they haven't changed their model. And we develop a good relationship with them, understand how they work, how they communicate. Once we like them, we're investing our own money in them, and we really get a good sense of them. Then it's just a matter of making sure that these investors get a chance to see some different things. And so that's what Thompson Investing is all about, just making sure that people can see some different looks. There's some great operators out there, and we just want to make sure that they're exposed to them. And some they can't get access to. We have some operators that, 500,000 or higher is a minimum. So we'll create a sponsorship and work directly with them. The operator likes it, but they're basically institutional grade, and they're hard to get investors into. So we'll lower the minimum for the investor at 50,000 and get them in. So we're trying to perform a service. We have a portal. I think that was bad. I caught 2 or 3 questions ago, but I mean, at the end of the day, we're trying to create a complete customer experience for people. So investors are looking for that, not just the deal. They want, once you're in a deal, you're in these deals for 3, 5, 10 years with people. Okay, I don't know if people understand that. Like when I do a deal with mobile home parks, 5 or 10 years, I have to work with these people. So it's important that we select them carefully, that once they're in, that we're communicating well. But this customer experience thing is often under discussed. But if it's a 5 or 10 year relationship, the deal and the numbers were maybe 1 month of discussion, and now you're in 10 years of discussion of interfacing with them, right? So it's important to, when you're thinking about this business, to think about it holistically, right?
Excellent. Well, we have about 5 minutes left. I want to give everybody a chance to answer one more question. But before we get to that, I want to address the people that have posted questions that we did not get to. Make sure you go to mfin.com forum.com, and put your questions out there, and we can get those answered for you, because we're just going to run out of time before we get to the end of the session. But before we go, we're going to ask each panelist what's one piece of advice you would give anyone getting started with raising capital. So we're going to limit this. We got 5 minutes left, so let's limit this to a minute each. Let's see. Let's start with Veena. Oh, we just lost our video feed.
There she is.
Come back. I'm trying. Am I back? Can you guys hear me?
Yeah.
Yep, you're good.
Okay. Sorry. I break all technology around me all the time. So this is very much in par with my record. So the one piece of advice I would give somebody is, on your first deal, you are not going to sleep. You are going to stress. You are going to think you will never make your raise amount. But the first deal is just getting the monkey off your back. After that, it becomes a lot easier. And when you start performing, you'll see it kind of snowballs and raising capital. So the first million is like the hardest to do. And then the second deal, it'll be a little bit easier. And then the third deal, it'll keep snowballing and it'll grow exponentially. So don't give up. All of us go through this. We all understand what it's like to have $1 million check fall out in the 11th hour and be hustling and scrambling. So I think that this is a team sport. I'll call Ellie when I'm having something that I'm like, what do I do about this situation? Or I just need to vent. So have relationships with other syndicators who've been in your shoes and they know what you're going through and they understand it. And they will help kind of be that shoulder for you as you're trying to get through that first raise, because it is hard. You're asking people to trust you with a lot of money. And I think if you treat them really well, I treat every single one of my investors as if it's like my mom or my dad or my sister investing into our deal. And I treat everybody like that because that's how important each investor is to me. So keep your relationships, make sure you're communicating, and then have a mentor or someone that you can kind of turn to when you're having a tough time or you're just stressed out, because we've all been there. We've all overcome it, and you will too. It just takes a lot of persistence.
All right. And I'm going to direct that at, let's see, Ellie, let's give that one to you next.
Yeah, so actually I think the most important thing is to team up with a more experienced operator when you just start. And teaming up can be one of two ways. Either get a mentor, and that's okay to pay someone, or provide some sort of value so you can actually learn from someone who's been there, who's been doing that for a while, or partner with someone that is more experienced. So you can rely on their reputation and also learn from them. So if you're just starting, I would say don't do it on your own. It's going to be a lot easier and more efficient and better to do it with someone who's a lot more experienced in that.
All right. And Ryan, let's give it to you.
So I would like to echo some of those comments that Veena and Ellie shared. I would say, pick the right partners, surround yourself with people that are more experienced. That's how you're going to learn. It's how you'll, reduce that learning curve. It'll get you off to a great start. And Dave Thompson and we've done a lot of deals together. I've learned a lot from him. He's my mentor, and it's been a great working relationship. And I just think that there's so much potential in this business, and there's a lot of opportunity out there. So for me, I would say I get a lot of first-time capital raisers or people just interested in how to kind of overcome that initial conversation. And what I say is, when I'm sitting down with an investor, what I'm thinking is that back of my mind, I'm just sharing an opportunity with someone that I care about or someone that I think would have interest in knowing. Because the number one thing I hear from all investors is like, God, why didn't I know about these types of deals 20 years ago? I mean, imagine what my net worth would be had I started investing in these types of deals. And it's just like light bulb went off. I'm like, all right, I'm on a mission now. And my goal is to spread the word about real estate syndications, or just kind of the benefits, the value, and just, so I get really excited. And at the end of the day, when I'm talking to an investor, I'm not nervous about like sharing the opportunity. It's never about selling. It's just about educating. It's about building relationships. So I really get excited when I do that. And I tell myself, look, if someone else were to approach me with an opportunity, I hope they would at least think of me as someone that they'd want to talk to about this. And so that's kind of my mindset when I talk to someone else. It's just about being collaborative and sharing, and we're all kind of in this together. And like I said before, it's a team sport.
Excellent. Thank you. And Brian?
So before I was in the syndication business, while I was building my real estate business, I was working in law enforcement. My very first time I ever took an investor's dollar was when I set up a small fund when I quit my job and told all the guys at the station what I was doing. And I ended up with a blind pool fund full of investors that all carried guns. And my life absolutely depended upon my ability to protect their capital and not lose their money. So my suggestion to anybody that's thinking about raising money from investors is treat this business and treat your investors as if your life depends on it, and protect them from day one all the way to the end. And I've survived 20 years in multiple market cycles in this business because that's the practice that I take. And I highly suggest that if you're going to take someone else's money, that you treat this as a responsibility and not just a fly-by-night business. This is not a paycheck, it's a payday. And if you perform, you will do very well. If you're here to just rake off a few dollars in acquisition fees and disappear, please go find something else to do, and don't take money from other investors. Else we'll be seeing you around at the jail one of these days, feeding you frozen meals in an orange jumpsuit. Please don't do it. Please. I beg you.
I definitely think that's sound advice. David, we're 3 minutes past our time, but real quick, I want to get your best, your final advice for those wanting to start raising capital.
All right, one tactical and one general. Tactical, always raise 20-25% more than your target when you start, okay? You'll thank me later, okay? The second, it can go down over time when you get really good, right? Like the rest of the ladies here. You get really good and maybe 10%. Don't go lower than that unless you have a really big investor. The second thing real quick, Brandon, I think is really critical. When I got in this business, I came out of the sales and marketing world when I got out of college, and I did terrible at it. I flunked. I would give myself an F, minus, and I went to graduate school, and the rest was history, 15, 20 years of corporate world for me. But when I got in this business, I started doing it. I did it on passion. I did it because I loved it, and I finally found out they paid me for it. I was like, this is great. Just all the time. But at the end of the day, I realized if someone would have told me it was sales and marketing I got in this business, I wouldn't have done it. I would have closed that door because I had a bad experience with it. I didn't do it for 20 years. So don't think it like that. I think Ryan hit it on the nose. If you come at this like most people don't even know this even exists, and you are educating them and answering questions. And then the more informed you are, the more confident you are, they become confident in you, and it just starts that relationship. And now you introduce them to an opportunity, they get in, they like that experience, and they come back. It's nothing scary. And if you're doing selling, you're doing it wrong. You're doing it wrong. So yeah, educate first and always, and really I think you'll be much more successful and you'll relax about that, because that's not the way this business works. It's not about in your face, hardcore selling. Maybe broker dealers do that. That's not how we work, right? Okay.
Excellent. Well, thank you all again for joining us. Thank you for your great advice. I hope it was beneficial to everybody. If you have further comments or questions that we didn't get to, be sure to go to the forum. And it is mfinforum.com. You should have a link with a username and password to that. Post your questions there. But thanks again, and everybody have a good rest of the day. Oh, there's Dan.
Hey, Dan.
Hi, Dan.
Thanks, Brandon. Thanks, Dan. Thanks,
Yeah, thanks again for having us.
Thank you so much.
Thanks, guys.
Thanks.